Of SBFC Finance Limited, hosted by ICICI Securities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Rinesh Bhuva. Thank you, and over to you, sir.
Thank you, Muskan. Hi, good morning, everyone. Welcome to SBFC Finance Q4FY24 earnings call. On behalf of ICICI Securities, I would like to thank the SBFC management team for giving us the opportunity to host this call. I will now hand over the call to Mr. Sanket Agrawal. Over to you, Sanket.
Thank you, Rinesh. Good morning, everyone, and welcome to the Q4 earnings call for 2024 for SBFC Finance. We have uploaded a presentation on Saturday. I hope you got some time to look at it. With me, I have Mr. Aseem Dhru, MD and CEO, Mahesh Dayani, CBO, Narayan Barasia, CFO, and Pankaj Poddar, CRO. We'll keep the format as same as the last quarter. We'll start with the opening remarks from Aseem, followed up with Narayan's details on finance, and then we move on to the Q&A. Over to you, Aseem. Thanks.
Thank you, Sanket, and good morning, everyone. Thank you for taking your time out for this call. FY24 was a coming-of-age year for SBFC. Exactly a year back, we were on our roadshows meeting investors in the run-up to the IPO. Investing is an act of faith, and we are really touched by the response we got. Strong mutual fund support, FII interest, family offices, portfolio managers, and at more than 2 million, one of the highest retail applications of any Indian IPO. We are now, with our report card in hand, a year later, standing in front of those that put their faith in us, presenting you with our fourth earning update. We had indicated 4 things in our meetings, and some of you who we had the opportunity to meet, would probably recollect this. 1, we had said that growth till FY26 will be at 5 to 7% quarter on quarter. Happy that we have exceeded this by a mile in all 4 quarters we have reported so far. 2, cost to AUM will see a 50 basis point reduction over the next 2 financial years. We decided to invest a little more in growth this year in terms of branch expansion, and towards this, we have delivered a 43 basis point reduction. 3, credit cost will move in the band of 80 to 100 basis points. For the year, it's been steady at 80 basis points. We will exit FY26 with a 15% ROE. We have gone into the IPO with an 11% ROE and have exited FY24 with an almost 12% ROE on a fully diluted capital base. We are happy now how far we have come, but super excited about where we are headed. We are building for the decade, so it's useful to track progress. It's like a milestone every quarter. The lending business is an adventure sport, never a dull moment. Last year too did not disappoint in terms of the headwinds that came our way. So if you see last year, 1, availability of funds for NBFCs got crimped thanks to the gravity-defying CD ratio in the banking industry. 2, the cost rose thanks to the earlier point, plus increase in regulatory risk weight by 25 basis points. 3, regulatory tightening moving towards zero tolerance of policy breach and lack of customer fairness. 4, post-COVID, Indian economy bounced back higher than any country, which created a Goldilocks scenario in lending and robust demand with sustained credit standards. The flip side of this was demand for trained professionals, and the industry faced the highest attrition it has seen. Now, a good sailor doesn't expect calm weather. If you are running a lending business, storms are the norm, calm is the exception. We anticipated that the year's biggest challenge was to ensure cost of funds is contained. We could see that the banking system is struggling to finance its own growth, and the regulators are also asking NBFCs to not be too dependent on banks. Towards this, after our rating upgrade to AA-, we moved towards NCD to borrow from the market, and it is now 8% against 1% of our borrowings last year, and we increased coordination to 18.5% against 11.6% last year. We converted 17% of our borrowings into fully hedged FCNR loans, bringing down the cost substantially. These are short tenure rollovers and subject to bank agreeing to roll over every half year. We added foreign banks to our lender book. A net of this is that we ensured we reduced our bank borrowings from 70% to 57%. Going forward, we will add some DIIs to the lending table, further diversifying our borrowing book. Resultant, our Q4 24 versus Q4 23 borrowing costs have gone up by 37 basis points, and quarter on quarter has reduced by 8 basis points. On the asset side, we increased our Q4 to Q4 yield by 112 basis points, ensuring our spread went up by 76 basis points during the year. I would like to explain a change in recognizing income that we have made in the current quarter. Co-origination is a recent phenomenon, and towards this, the right accounting treatment has been evolving. The transaction is akin to a DA in many ways, and therefore the excess interest sharing that we get from the bank, it has been now decided to group it under the interest income. This change has a positive impact of 45 basis point increase in yield and a corresponding reduction under the head of fee and other income. If this change wasn't done, the Q4 versus Q4 yields would have still been up by 67 basis points, and quarter on quarter it would have been stable at 17.18%. If you refer to page 22 of the investor deck, it depicts this with reasonable visual clarity. We added 31 branches against 17 last year, and our business grew by 38% year on year. Our asset quality was stable at 2.43% at the lower end of our guiding range. Our PCR has moved up from 39% to 45% YOY. Our profits grew 58% YOY to 237 crores, ending with a ROA of 4.14% and ROE of 11.28% during the year. The exit ROA is 4.56 and ROE is 11.9. We reiterate our guidance for 5 to 7% quarter-on-quarter growth, reduction of cost by 50 bips, and credit costs in the range of 80 to 100 bips. Highlights during the year: our listing, rating upgrade, inclusion in the MSCI Global Small Cap Index. Post-listing, we added 2 independent directors that bring in vast experience in the fields of finance and technology. The revised board, led by an independent chairman, has 5 independents, thus ensuring majority board is independent. Co-origination book crossing 1,000 crores, ISO certification of our technology and other functions, upgrade to a new LOS, and skill development and job creation of 400 fresh pass-outs from the economically disadvantaged background. We adopted a school under CSR, and we have rebuilt, added classes up to 10th. Next year, we'll take it to 12th, installing Google Classroom computers, resulting in 101 students, including 53 girls, getting better education. The highest joy we get by serving customers that hitherto did not have access to formal finance, being a platform of equal opportunity for all our talented staff. Last year, we paid almost 90 crores of income tax during the year. And over and above this, there would be GST, there would be local taxes, municipal taxes that we contributed. So hopefully we are a good corporate citizen, benefiting the society in which we live in. And in over 250 towns, that we reach out to, we spread this joy. I join the 3,758 SBFCians in thanking you for your time and interest in listening to this call. I now hand it over to Narayan to take us from here. Thank you.
Thank you, Aseem. A warm welcome to you and a happy Monday morning. In terms of business, our AUM grew by 38% on a YOY basis and 9% on a QOQ basis. The AUM stands at 6,822 crore as of 31st March 2024. Our MSME AUM grew 46% on a YOY basis and 9% on a QOQ basis to 5,704 crore as of 31st March 2024. We added 31 branch during the year. Our average ticket size of the MSME loans remains at 9.6 lakhs per loan. In terms of borrowing, our borrowing cost has reduced by 8 basis point QOQ, as Aseem was mentioning, and is at 9.38% for the full year. Post our rating upgrade by India Rating to AA-, we have diversified further and have raised money under NCDs from mutual fund and have added a couple of foreign banks as well. We are further looking to diversify borrowing as we go along in future. In terms of asset quality, our GNPA is stable and range bound. It is at 2.43% as of 31st March 2024. Our credit cost is steady at 0.8% for the year. Our PCR is increased further to 44.74%. In terms of capital and return ratios, our yields on the loans are at 17.08% for the full year and 17.62% for the Q4 FY24. The spread for the full year FY24 is 7.7% and for the quarter is 8.31%. Our OPEX is at 5.34% of the AUM for the full year FY24 as against 5.77% for FY23. OPEX for Q4 is further lower at 5.01%. Our return on average AUM for the full year is 4.14% and for the quarter is 4.56%. Our return on average equity, average tangible equity for the full year is 11.28% and for the quarter is 11.9%. Our capital adequacy remains strong at 40.5%. Our tangible net worth is at 2518 crore, 2518 crore as of 31st March 24, and our debt to tangible equity is at 1.6 as of 31st March. The PAT for Q4 is 73 crore, thereby recording a growth of 15% on a sequential basis. The PAT for full year FY24 is 237 crore, thereby recording a growth of 58% on a YOY basis. With that, over to the questions and answers.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask question may press star and 1 on the touchtone telephone. If you wish to remove yourself from question queue, you may press star and 2. Participants are requested to use handsets while asking the question. Ladies and gentlemen, we'll wait for the moment while the question queue assembles. The first question is from the line of Kunal Shah from Citigroup. Please go ahead.
Yeah. Hi. So first is with respect to the overall OPEX and the employees. So there have been almost like 220 odd additions to the employee during the quarter. So if you can just highlight in terms of maybe what verticals these are being added. There is almost like 6 odd branches additions. And similarly, maybe with respect to the overall cost, we had seen an improvement, but how do we expect the overall cost to assets to settle? Yeah.
Okay. So see, we have continuously been investing in infrastructure. So what you're saying is right. The number of branch has been continuously going up at a slow and steady pace. So we added about 6 branches in this quarter. So the investment in terms of people is happening throughout in terms of new branches, but as well as increasing more resources in the branches where we are able to do well. So it is all across. We are originating a long tenure loan. And so by that meaning the operating leverages will keep on improving. We further expect that from here on the OPEX should further come down while the investments in the branches is continuing.
So in terms of the addition to employees, maybe the branch oriented would be a significant part of it, or these are in other verticals as well?
No, so significant will always be branch.
So Kunal, I think if you look at the total structure, every quarter we've been adding close to around 6 to 7 odd branches. So if you probably cumulatively look at the number, you'll have close to around 14, 15 branches in the last 2 quarters. And roughly we have 14, 15 people in a particular branch, including gold and any. So that largely sums up the overall headcount which is there. But that's largely the customer-facing roles that we actually invest in. In addition, we are also beefing up the collections infrastructure, where the number of employees that have come through in the last quarter. So that largely sums up the 200 plus number that you've seen the delta come through in the last quarter.
Sure. And secondly, any plans on housing now? Are we reevaluating the structure? How are we looking at it? Maybe obviously from the regulatory side it was quite clear, but any reevaluation on that front?
So housing is we are seeking the regulators nod to get the license. If that comes about, we do housing. Within the NBFC, where it has been a little bit of a stretch to start housing loan because the unit economics have to add up. So we are waiting for a subsidiary nod to get into that business. As and when that happens, it's fine. Until then, we stay focused on what we are doing right now.
Sure. Okay. Yeah. Thank you.
Thank you. The next question is from the line of Shubhranshu Mishra from Phillip Capital. Please go ahead.
Hi, two or three questions. The first one is on the co-origination. What is the unit economics here in terms of cost of fund sharing, OPEX sharing, and credit cost sharing? And where do we think we will end up in terms of percentage of AUM in the next 2-3 years? Second is on the ALM. Given the fact that we lend long, would we want to, match the ALM and borrow long, which will have a detrimental impact on our spreads as in how we borrow long? So that's the second. Third is on the PCR at stage 3. So in India, the PCR on stage 3 is closer to the LGD. Given the fact that we have largely secured assets, this seems a high LGD if my interpretation is correct. These are my three questions. Thanks.
Okay, so let me take the broad construct on the co-origination piece. I think what we've been guiding also is that we're very comfortable for our co-origination to be at almost 18 to 20 odd %, and that's the range that we've been at. This is largely at a disbursal level, so obviously at an AUM level comes with a lag. So if you look at our current numbers, so you would probably see our disbursals also in the range of 20 odd %, a couple of % here or there. Also, as Aseem in his opening remarks mentioned, that now as a percentage of the overall AUM, the reliance on co-origination is now almost close to 18%, which is up from 11% from last year. Moving forward, we expect the current trajectory and the momentum to continue. We feel with a higher base, we will be able to continue to build at 18 to 20% of our disbursements. And as a result, our AUM will also move in that particular direction. I think co-origination is an excellent tool. It's a great ROE enhancer, extremely profitable. And obviously, from a liability construct perspective, it helps us on our overall AUM build-up as well. We don't call out the exact unit economics on the co-origination bit. That's something between us and the co-originating partner. But we'll just like to leave you with it saying that it's a great ROE enhancer for us, and hence it's at 20% of our overall current AUM and disbursal as well. Narayan, you might want to pick it up on
in terms of ALM on the asset side first. The secured MSME obviously is a long tenure asset, but at the same time, gold, which is a 15% of AUM, is a short tenure asset. So in a way, the weighted average on the asset side comes to roughly about 4.5 years. But on the liability side, you are right, liability in the market is not available for so long. So what we do is, number one, we don't borrow any short term. That's what we do. We try and maximize the tenure on the liability. At the same time, coupled with the liquidity we keep, I think we don't have any ALM mismatch on any bucket from an ALM point of view. On PCR, we have been constantly increasing the PCR. We were at 39% last year. We are at 45% now. You're right that the LGD on these assets would not be more than 20-25%, adjusting for time value. But we create a war chest for a cycle to turn, and credit cycles do turn. And therefore, we create a double of what regulatory requirement is, and we continue to strengthen our provision coverage ratio. During the quarter as well, we have created additional provisions to the tune of 1.5%, taking the overall PCR up to 45%.
Just to slip in one last question, this increased PCR, is it a posturing for the credit rating agencies for a better rating?
So on the PCR, basically, as per our model, it starts at 35%, and our endeavor or intent is that we keep it above 40%. So from a model standpoint, we would like to keep our PCR in long run above 40%.
And just to clarify, there is nothing from a rating perspective.
Thank you. Those are my questions. Thanks.
Thank you.
Thank you. The next question is from the line of Rinesh Bua from ICICI Securities. Please go ahead, sir.
Yeah, hi sir. Just two questions from my side. One on the asset quality. So when we look at the gross NPA ratio, of course, it's a range bound, but on sequential basis, it went up by 4-5 basis points, despite the higher denominator, wherein we saw the AUM growth growing by 9%. So which essentially reflects that, the forward flows are still high. So could you please throw some light on, what is happening at the underlying ground situation?
So, see, as you rightly said, our GNPA numbers is range bound, and that is based on a model where we expect that to be around 2.5%. The portfolio, if you look at in last 3 years, we have seen a growth post-COVID, and there is a portfolio maturity curve also which is hitting. From a model standpoint, we expect the numbers to be stable and range bound, and we don't expect any impact on the credit cost side. So credit costs we expect to be stable around 80 to 90 basis points.
Okay. And secondly, on the secured MSME disbursement side, so when we look at the ticket size, it went up pretty sharply on sequential basis, and similarly the volume sort of has moderated. Plus, when we look at the, let's say the AUM vintage-wise on the branch between 12 months to 36 months, again there is a sharp fall from 43 to 31. So, what is happening at those branches? Ideally, the branches with more than 12 months vintage AUM should, keep on increasing. Why there is a sharp fall on sequential basis?
Yeah, so I'll take the first one. So largely on the co-origination, that probably explains why the ticket size went up. So the ticket size went up to almost 9.67 lakhs, and this was at almost 9.38 lakhs. But it's still lower than probably what was recorded last year in the similar quarter of above 10 lakhs. Last quarter, it's consciously by design that we had moved our reliance on co-origination slightly higher, which explains that on an average basis, what we maintained is our average is going to be between 9 to 11 odd lakhs. So by and large, it should hold up. So that explains the disbursal and why the average ticket size marginally being higher. With respect to the average AUM per branch, if I were to give you some comparisons related to the branches which are matured and which are more than 36 months, there were 11 branches which moved up, which were more than 3 years, where the average is now hitting almost 50 odd crores. There were a significant number of branches. For the full year, there were close to around 31 branches which got added, where the average is being between 8 to 9 odd crores. And the 12 to 36 month branches, a high number of branches moved up into the more than 36 months bracket, and that's where you see a significant bump up coming up there. So if you look at the overall trend, even if you probably look at towards the end of the year trend for the last year, you will see the 12 to 36 month bucket is moving towards or close to around 29 to 30 odd crores, and that's what we've been talking about. And as the branches are maturing more than 3 odd years, you are now beginning to see it now hitting out 50 odd crores. If you were to even do a peer group analysis and probably look at it, for more than 3 years, you would see similar ticket sizes in the range of close to around 30 to 40 odd crores. So at least that bucket is doing significantly better. Even if you were to look at 12 to 36 odd months, you would see industry moving anything between 18 to 22. So we would probably be there. But during the year, as you start seeing these aging, you would probably see them gradually going up. But these are range bound and will continue to be range bound. As per our internal threshold that we maintain, we feel that in 3 years, your branches on an average should be 30 odd crores. That's the internal benchmark that we take. And as long as we're hitting that, we're largely comfortable.
Got it. Okay. Thank you, sir, and best of luck.
Thank you. A reminder to all participants, you may press star and 1 to ask questions. The next question is from the line of Nischint Chawate from Kotak Institutional Equities. Please go ahead.
Hi, good morning, and thanks for taking my question. This is actually on the math on co-originated income, and I think in one of your slides you have shown the bump up in yield this quarter because of co-origination income being recognized out there. I think the number works out around something like 6.5 crores, and that's approximately around 2.8 to 3% of loans outside balance sheet. So is that a fair run rate to assume? I think that's what my question is.
Yeah, Nischint, you're right. The amount is closer to 6.3 crore. That has been reclassified from fee income relating to co-origination to an interest income. That is given a 0.45 basis uptick during the quarter, and that's what you see the bump up from 17.17 to 17.62%. And the yields from quarter across the quarters have been stable at 17.2%. There are two adjustments during the year that has happened. One in quarter two that we did not book interest on NP. That was one adjustment. The second adjustment is on this co-origination interest income. Net of both of these, we continue to have yields in the range of 17.2%, which is sustainable for the foreseeable future.
Sure. And just very simply, if I look at loans outside balance sheet that you put, basically AUM minus loan book on balance sheet, and I look at the, I try to kind of look at 80% of the co-originated AUMs. It doesn't fully tie up. I mean, there is a small difference.
No, it cannot be. It cannot be. We can take it offline and take you to the numbers. This will exactly tie up. Yeah.
So on the other,
this is the EIS, the 6.3 crore which Sanket mentioned and you were also mentioning is excess interest spread on the off book as what you mentioned. Is absolutely the same.
That's right. The other thing is on asset quality. If you see gross stage 2 loans have increased in the last 2 quarters, and the ratio has also gone up on a year-on-year basis. So how should we think of it? We know that FY23 was obviously an exceptionally good year because we came out of COVID. And, is this going to be like a new norm, or is it something which has kind of bumped up in last 2 quarters and we are trying to reduce it?
Yeah, so overall, if you look at stage 2 assets, quarter 4 was 3.55%, which is 4.37. Within this, if you look at MSME, that is around 3% range earlier and it is around 3.2% range now. So we expect this number to be range bound. There was a slight increase we have seen in gold in terms of stage 2, but that also is based on the asset from a positioning standpoint. Earlier, the stage 2 and stage 1 contribution used to be 90% plus current. The numbers remain same. So we expect the numbers to be stable from here on. So on stage 2, if you look at MSME, remains stable.
Sure. And gold, when was the last time you did auctions?
We do quarterly as an exercise. So based on the aging, when customer hits 90 plus, as a process, the auction process gets conducted.
Sure. So basically, the bump up in gold's GS2 is basically gold. Also, I think that's what I'm reading it.
Yeah.
Sure. And anything on the outlook on the MSME business? Given the fact that this year you have kind of exceeded your guidance. How do you see the economy going forward? We are sort of just getting into an election, so some of your peers have kind of given a little bit of given a little bit of a caution. So just wanted to get your sense, how comfortable are we to kind of have the current run rate?
So
carry on.
So Nischint, we are just coming out of a Goldilocks scenario for lending that was there last year. And this year, the headwinds are clear. Now, how we navigate is a different story, but the headwinds are clear that the regulator is basically guiding the industry for a lower growth. I mean, it is all but telling the banks that it would want them to soften down and improve the CD ratios over time. So one, is that the regulator has been guiding a lower growth, and eventually the industry always moves to what is regulatory guided. So we will see a slowdown of loan, being across the system next year, in my opinion. The second is that NIMs would be consistently under pressure as the scramble for liabilities will continue. The stock market continues to be buoyant. then the banks will continue to struggle for deposits. So, and then the price of the deposits will move up. The U.S. Fed has crossed 5%, and when U.S. Fed crossed 5%, and the dollar is also getting stronger. Yen has moved towards its historical weakness, and we are seeing that the Indian rupee. You saw Indonesia also trying to defend its currency. So the RBI will still have its act to do to ensure that the currency remains under control. And with that, there is no chance, in my opinion, of an interest rate decrease happening in the U.S. as well. Forget what would happen in India. So the likely scenario is that the repo rate will continue where it is for the year. Bank MCLRs will continue to leak into our cost of funds, and NIMs will be a challenge that all of us will have to address. And we have coming out of a extremely low credit cost as an industry, and from this kind of a low, chances of it going lower are ruled out. Chances of it inching up a little are more likely. So I would say three clear headwinds for the industry and for us as well: protecting NIMs, ensuring growth, and ensuring the credit cost is under control.
Just one last point here is, one of the large private sector banks has significantly raised lending rates in business loans, and does that mean that it gives you tremendous pricing power to kind of maintain your margins as well?
So see, we are a very small company, and generally the GDP, the economy doesn't affect us. We are solving for a very small problem for a specific set of customers, which are the small customers. We are solving for excess. We're not solving for speed, etc., or competitive pressures, because most of the customers we lend to are first-time commercial borrowers in a sense. They have a CIBIL score which has come out of small assets loan they have taken. So so these set of customers are not so price sensitive, and you are able to price what is reasonable. And we also want to ensure that the IRR of the business should be sufficient to price it, because the minute you price it beyond what the IRR of the business is, you are inviting trouble eventually. So we have to be cautious. It is not that we have unlimited pricing ability, but we have to be cautious. But wherever we see that there is an opportunity to price something which is within range, we would go for it. So as we have, if you've seen our results last year, we have increased our yields across the year, and we'll have to see how the year pans out, and how do we navigate the year. How do we ensure that the right jaw between the yields and cost of funds is maintained, and that it doesn't clench down. So that is going to be the challenge, which we think we will handle it as the year goes by.
Perfect. Thank you so much for all your clarifications. All the best, gentlemen.
Thank you.
Thank you. The next question is from the line of Lakshmi from Tunga Investment. Please go ahead.
Yeah, this is Lakshmi Narayanan here. A couple of questions. First, I just want to understand what kind of loan rejection ratio you have. I just want to understand your funnel, how many people apply for, and how many goes through the check, and then finally how many people end up getting the loans disbursed.
So on the approval rate, typically we look at the credit logins. Typically 50% is the approval ratio. What comes to the credit from a login standpoint, 50% goes through.
Okay. And second, in terms of the MSME, can you just give some little details on how the various sectors in MSME, what kind of breakup you actually have, either in terms of the size of the business or in terms of the industry they operate in?
Mahesh, you are taking this?
So these are largely, consumption-related, businesses. These are the mom and pop stores. And obviously, when your ticket sizes are between 9 to 11 odd lakh, so these are largely non-manufacturing. So if you look at our target customers, these would largely be classified as micro enterprises, but most of them would be typically under the service enterprises. So these would be your retailers across segments. These could be converters. These could be salons. Any establishment that you can probably find in your neighborhood would be a typical customer.
Got it. And what kind of balance transfer out happens in your customer segment, and from where, you mentioned that most of them are maybe first-time formal borrowers, and who you actually lose your assets to in general, if you look at in the last 3 years or 2 years, where actually it goes, and what are your plans to arrest it?
So if you look at the entire secured segment, which is largely by property, almost 80-85% of our customers are borrowers for first time against their commercial or residential property. So they would have a typical credit score, but they would be borrowing against their property for the first time. So almost 85% of our customers who we disburse are of that category. So we don't take over those set of customers. We would tend to take over some of the customers which would be in the range of between 10 to 15 odd percent. That's on the incoming customers. In terms of outgoing, what we typically say is that while our door-to-door tenure of loans would range from anything between 7, 12 and 15 years, but behaviorally these customers are with us for largely 5 years. And, as these customers are credit tested, their scores obviously move up with the right kind of repayments. Ultimately, they would migrate, and they would migrate into the private banks or, public sector banks, some of the public sector banks who can offer them significantly lower rates. So we've seen an entire spectrum. So not any particular bank per se, but you would have different banks in different geographies, who would probably want these customers over a period of time.
And you have a 3-year exit thing for your customers, right? So if they exit, they have to pay a penalty on the total disbursement amount or something like that?
Not all. So it's a part of the agreement. Wherever it's applicable, they would, they would pay. But we've not put in a minimum clause that they have to be with us for 3 years. It's not a part of the agreement.
Sorry,
you can't technically do that. Yeah.
Sorry. And one last question. Once you disperse the loan, how do you? This is a typical practice I see that till the loan is dispersed, most of the finance institutions do diligence, and post that, as long as the money comes, they leave the pedal. They just don't do it. So, do you do something differently where you actually, after the loan gets dispersed, you keep corroborating the GST, or you do subsequent analysis whether the particular borrower is doing better, the cash flow is improving, or some process you have in place, or how do you do that?
Unlike banks, who operate overdraft account or a cash credit account, which are largely operative accounts where you probably can look at the end use even post disbursals. Unfortunately for NBFCs, we don't have operative accounts. But what we typically do is something which is called hindsighting, where we look at all customers who've been disbursed as to how the pattern has been. Second is obviously we keep evaluating, the valuation of the property and do some kind of checks. But on a transactional basis, that obviously, doesn't happen. Our customers, most of our customers aren't really the GST range customers. If you're considering the total borrowing that they do is, 9 to 10 lakhs. So they're largely out of that, ambit. So very unlikely that, those kind of variables and the transaction monitorables are going to be there.
Just to add, we also do, so as part of portfolio management exercise, we also do bureau scrub and trend analysis. That also tells us how the portfolio is behaving, and if there is any area where we have to look into, that gets actioned.
Well, thank you so much.
Thank you. A reminder to all participants, you may press star and 1 to ask questions. The next question is from the line of Lakshmi Narayan from Tunga Investment. Please go ahead.
Yeah, thanks for the follow-up. So there has been a sounding off by the regulator saying that the microfinance institutions have to bring their interest rates slightly down. Right now, how does that impact a player like you? Whether how positively it would impact or negatively it would impact?
So, I mean, see, ultimately, what the regulator seeks is that there is a fair practice code that you put with customers in all its true spirit. So it would want that you are lending at a rate which is not usurious. It would want that you are transparent to the customer and there are no hidden charges or nothing not disclosed to the customer. It has to be fair to both parties. So at the moment, what we are doing is that we are pricing it for risk, and we are not. I mean, if you look at our lending category and and look at our peers, we are not at the higher end of the lending. There are several peers of ours who are lending at a much higher rate to similar set of customers. We are lending where we believe is a fair rate to both of us. And I don't think the move and any move being planned there is going to have any impact for now as what we understand.
Got it. And if you look at risk going forward in the next 3 to 5 years, what are the three key risks you actually foresee for you as well as the industry? I think for the industry you talked about NIM compression and also little lower asset growth. But for you per se, what do you look at as risk and what kind of efforts you are making to counter them?
If I tell you the risks, we have, how much time do you have? I can go until afternoon. So the reality is that in a lending business, everything affects you because you are lending it's a derived demand. It is not a principal demand. Nobody needs a loan for the sake of it. People need things and therefore they take a loan for it. So eventually, it depends on which end of the spectrum you are. We are not on the consumer end of the spectrum. So a lot of in the consumer end of the spectrum, the worry would be whether the money is going into creating assets, or money is going into consumption, which could not be a good growth of loan to have. We are in the business loan segment where we are lending to small businesses who are not leveraged. This is the first time borrowing that they are doing against property. So to that extent, we are doing what is the very, very traditional finance. And ultimately, the risks come more from our own operating efficiencies. The risk comes more from our own credit judgment because ultimately the borrower is not somebody who has wonderful tax audited statutory reports, and none of our borrowers file GST. They are way below that threshold. So the ability to really understand the customer and sift out data points which give the confidence to lend is data driven with a fair amount of judgment also in it. And whenever you are doing even a little element of judgment, the risk of the lending goes up, which is justified by the higher interest rate that we charge. Then it makes ROC efficiency. So really the risks to us, one comes from the environment, which is what I mentioned earlier. The second risk comes from our own foolishness and mistakes. And the third, is in misreading the environment or taking steps like too fast a growth, for example. Now we have to take a growth rate that we are comfortable with in terms of managing the outcomes, and we have to keep watching our portfolio for what signals it is giving us. So we are still at the end of the day just a 6.5-year-old company, and we have to be careful. We have to watch many cycles to be able to be confident, that yes, now we have got it well. So we are still figuring ourselves out. We are learning. We are making mistakes. We are correcting, and hopefully we are improving.
Got it. And in terms of the gold portfolio and the SME portfolio, what is the yield you get on gold?
Mine's gold.
So in terms of the yields, we are now closer to 18%. And in terms of the MSME, we are in the range of 16.75 to 17%.
Got it. And from a top-up loan point of view, what is the what kind of retention you have on the gold loan in terms of repeat gold loan? Because as you said, it's a short-term loan. So is it that, that is one in terms of retention. And second, in terms of the top-up loans, what percentage of your borrowers in MSME avail top-up loans? And what is your criteria to do that?
So typically what we do is that we wait for at least a year before we consider him for a top-up. And obviously the top-up has a lot of considerations to be looked at, whether his income has moved in line with his requirement, because that's where your FOIR is linked with, and whether there is sufficient margin available on his property side for us to give him that particular loan. So as I mentioned earlier, that our overall top-up doesn't exceed more than close to around 15%. So that's largely range-bound in that particular piece. With respect to the gold, it's a short tenor product. It's between 3 to 6 odd months that we onboard. We onboard close to around 3,000, 3,500 customers, every month. A lot of these customers typically, even after they close the loans, end up coming back after a few months. And typically what we see, some bit of repeat customers coming. They would be roughly close to around 30 to 35% would be repeat customers that would eventually come back to you.
Got it. Thank you, sir.
Thank you. As that was the last question for today, on behalf of ICICI Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.